So I briefly touched on it, but what is the importance of title insurance? Well, the lender's policy, right, the one that we got that is equal to the loan amount at the closing of the loan, ensures that the lender is covered for the term of the loan, as long as there's an active loan, for any document issues that may arise that were not noticed during the title review. The owner's policy ensures that the owner is covered for any covered losses for as long as they own the property. Now, why is that important? Well, let me go into the issues that are some examples of issues that are covered, then I'll relay an actual example. So issues that are covered include, but this is not an exclusive list, this is just some of the items: fraudulent or forged deed, unpaid property taxes, construction lien, any other unpaid liens like a municipal lien, state lien, tax lien, incorrectly completed documents, prior mortgage not paid off, or any unpaid assessments. Now, the unpaid assessments, mortgages, taxes, stuff having to do with liens, all of that is going to be covered in Section B, which I'll get into in a minute, Section B of the title commitment. So why is the owner's policy so important, for example? Well, I had a scenario where we closed on a transaction, right? The property was in foreclosure, but we closed it. We closed it like with 7 or 8 or 9 days to spare. But apparently, the title company did not send in the documents right away to record, as is the habit. Sometimes for title companies, they'll group together the items that they are going to record and then do them all in one shot. I don't know if they were trying to save a little money, but I would call that penny wise and dollar foolish. Because this property was in foreclosure, and not really sure what happened there, but obviously they didn't record the deed on time. And the left hand didn't know what the right hand was doing, apparently, at the lender that had the loan. Apparently, the foreclosure department didn't communicate with the payoff department, or vice versa. And they went ahead and processed the foreclosure. And like 2-3 months after we closed, I get a frantic call from my borrower, says, "Hey, Jose, there's a man here showed up at the door of my house telling me that he's the new owner of the property." I'm like, "What do you mean?" "Oh, yeah, he's showing me some court papers." So I went ahead, I called the title company, explained to them what happened. They realized what went down, right? So they negotiated with the new buyer and paid him $15,000 to basically go away, right? Because his deed got recorded first, right? So he took the money and they did whatever corrective documentation they had to do. And my buyer was still whole. WHOLE. She was still whole, still owner of the property, didn't have to move, disaster averted. But what would have happened in that situation there had the borrower not had owner's title? Well, the only thing that would have happened was that the title insurance, if they would not have been able to negotiate like they did with that the new supposed buyer, they would have just had to have paid the loan off, and that's it. The current owner would have been left out to dry with nothing, because the owner's title insurance wasn't going to protect them. So it was a good deal for a couple $100 that she paid for that owner's title policy. So, definitely you want to identify and address any issues up front. Make sure you communicate and collaborate with the title professionals, with the title company or attorneys that issued the commitment. Like I just said in the last slide, make sure you read the title commitment once you receive it. Do not just save it and submit it to underwriting, and then all of a sudden have the underwriter hit you a week later with some conditions that you're like, "Oh my God, how am I going to take care of this?" Make sure you educate your borrowers about the importance of title insurance, about lender's title insurance being required, about owner's title being optional but highly recommended. You can mention the anecdote that I spoke about, how my borrower got saved, didn't have to put a dime out of her pocket, and the title insurance company had to pay $15,000 due to that mistake that they made. And then last bullet point here, not necessarily having to do with reading title commitments, but if you do read the title commitment and you do see when the seller has been on title, if you hadn't already done that research when you were first structuring your loan, you definitely want to see how long the seller has been on title or how long the borrower has been on title if it's a refi, specifically a cash out refi. And why am I saying that? Well, because regarding seasoning, on a purchase transaction, MLOs need to review the property ownership transfers on purchases for non-QM and FHA loans, especially, to ensure that property flipping will not affect the loan requiring additional appraisals. Why do I say that? Well, because if it's a non-QM purchase and the seller just purchased a property, rehabbed it, and is reselling it 60 days later, and is reselling it for 35% more than what he paid for it, you're going to have to meet some additional requirements, right? You're probably going to need a second appraisal. You're going to need to document the upgrades that the seller did to the property. And in some cases, some guidelines may not even want to do the loan. I know one in particular that they won't do anything less than 12 months, regardless of how many appraisals you provide. So you don't want to get caught off guard there in that respect, right? And that's what we're talking about a purchase. We're not even talking about a refi, a non-QM purchase. Specifically, they're really strict on that. FHA also has the 91-day flipping rule, which means that an FHA purchase, you cannot get into contract until the 91st day that the seller has owned the property. If you get into contract on day 89, you're not going to be able to close that deal. You're going to have to cancel it, do a new contract, do a new transaction, do everything. So make sure if it's an FHA purchase, your borrower is buying that property, well, look at how long the seller has been on title. If it's less than 90 days, tell them you got to wait. If it's 91 days, you're good. But FHA does have certain requirements regarding flipping, depending how much profit is being made, and possibly requiring a second appraisal. And if it's a cash out refi, now, there's a little bit more common knowledge than the purchases, but I'll still restate it. If it's a cash out refi, the appraised value will definitely be affected if the seasoning on title is not met, resulting in using purchase price plus closing costs or purchase price plus closing costs and renovations, depending if it's, on the time frame of the seasoning. Now, we do have at the mortgage calculator 0 seasoning options, but the most common is 6 months seasoning, and then the most conservative, which there are a few options out there that still hold to 12-month seasoning option to use. And this is just to be able to use the appraised value and not have to use purchase price plus closing costs or purchase price plus closing costs and renovations. So as I know now, most of you now are probably going to change your method of operating. Now when you get that title commitment, you're going to open it up. You're going to look at Schedule A, Schedule B, Section 1, Schedule B, Section 2. You're not just going to save it, upload it to the conditions, forget about it, and then all of a sudden be hit with some weird conditions that you should have known had you read the title commitment, right? So I guess the greatest takeaway from here, if you don't remember any of the jargon we went over, the legalese, please at least open the commitment and read it and reach out to the issuer of the commitment with any questions.